I think by this point, it's pretty obvious that investors that buy into high quality dividend growth ETFs, something like the Schwab US Dividend Growth ETF, long term and consistently reinvest the dividends, will most likely, at least if history was going to repeat itself, not only be left with a ton of cash flow when it comes to retirement, but also a nice plumped up net worth to go along with it. But the question still remains, how much money does an investor need to invest into a high quality dividend growth ETF that not only grows over time, or at least has historically, but also has been paying bigger and bigger dividends year after year? In this video, we're going to break down the Schwab US Dividend Equity ETF known as SCHD, which happens to be my absolute favorite dividend growth ETF, and an ETF that's going to be the largest position in my over 7-figure portfolio over the next year or so. Then towards the end of the video, we're going to go through the math, and I'm going to show you how a relatively small amount of money is all it takes for a dividend growth investor to not only possibly retire just off of the cash flow from something like SCHD, but also maybe even retire early. Now, if this interests you at all, make sure to please drop a like down below, subscribe, and let's get right into it. So first things first, what are the basics about SCHD, or the Schwab US Dividend Equity ETF? SCHD is just like any other dividend growth ETF out there, but there are certain characteristics that do set it apart from the others, which is what makes it my favorite, which stick around, we're going to go through everything. But some of the absolute basics, SCHD has a total expense ratio of just 0.06%, so the ETF is pretty cheap to hold. Also, the SCHD's objective is pretty simple too. It says the fund's goal is to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Dividend 100 Index. And the reason on why that's important is because the Dow Jones US Dividend 100 Index has a very high quality methodology, or simply put, a very strict and professional way and set of rules the index follows. Also important, it says highlights for the ETF a straightforward low-cost fund offering potential tax efficiency. The fund can serve as part of the core or complement in a diversified portfolio. Also sounds pretty good. And tracks an index focused on quality and sustainability of dividends, which are going to be crucial, especially during retirement time, if you're someone like myself that are looking to use dividends to pay your bills and to live out life after you're done working. Now, looking a little bit deeper into SCHD and the performance of the ETF since the ETF's inception. Now, keep in mind, just because something has done something in the past, like say performance, it doesn't mean that it's going to happen the same in the future. But with that being said, of course, historical performance gives you somewhat of an idea of what something can do in the future. Now, around 12 or 13 years ago, SCHD started trading, and it was trading around $24, $25 until just around a few years later, it started already trading in the $30 range. Now, as SCHD sits right now, it's currently trading in the low 70s, which I personally think for a long-term investor like myself is still a great buying opportunity for someone that wants to buy into this ETF and hold it for many, many years from now. Now, just a side note here, I've talked about this in previous videos, but SCHD for me personally is my only buy and hold forever position throughout my portfolio. And although I do love other stocks and ETFs across my portfolio, my shares of SCHD, just for me personally, because of how fond I am of the ETF, are going to be in my portfolio and outlast most likely everything else within it. But to get back to the performance, the ETF is up around 172%, and that's not even including dividends. But year-to-date performance, this ETF is still red. It's still been lagging the overall market, which again could or maybe could not be a buying opportunity, but in my opinion, it is. Next, I think it's fair that we look through the holding breakdown for SCHD and where things are at currently. Things are going to move around over time. The top holdings are going to shift around and be weighted differently, but as of right now, industrials is still the largest sector when it comes to the Schwab US Dividend Equity ETF. Then we have financials, healthcare, consumer defensive, and technology. Now, one of the things I don't like about this ETF, which I've been pretty vocal about, I wish this ETF had a little bit bigger portion of technology, so it did have a little bit more growth potential, but with the way things are weighted right now, I'm honestly not complaining. Now, also important to note, the top 10 holdings for SCHD are some super high quality companies that I honestly would and do own just on their own throughout my portfolios. The biggest position as of right now is Broadcom. Then we have Amgen, we have Verizon, Coca-Cola, Pepsi, Merck, AbbVie, the Home Depot, Texas Instrument, BlackRock, and around 100 companies altogether. Now, a lot of SCHD investors, even fans of the ETF, have been sort of critical, saying that certain names within the top 10 holdings are names they don't necessarily like all that much. And there are a few names in here that I'm not a huge fan of. And just out of curiosity, comment down below which name you think I'm thinking of. There's one name in here that I'm not that big of a fan of. Comment down below and we'll see who gets it right. But moving right along to maybe the most important aspect of this ETF, and to go back to the title of the video, explaining why a relatively small amount of money invested into an asset like this that has the characteristics that this asset has could make for a very good retirement, even with less money invested than you might think. Now, what I'm talking about here is the fact that SCHD is currently offering a 3.5% to 4% dividend yield, trailing 12 month, somewhere in that range, which is honestly a massive dividend yield considering the growth potential in ETF price and of course also considering the dividend growth rate. Now, dividend growth rate is basically how much in dividends something is paying compared to the last 12 months. So for example, the dividend growth rate for SCHD over the last year was 5.7%. On the 3-year CAGR, 11.44%. On the 5-year, 13.69%. On the 10-year, 11.11%. And one of my favorite things to do is to actually look at the visual of the dividends that have been paid since this ETF's inception. And as you can see, basically year after year after year, with very, very few instances otherwise, the ETF's dividends have been getting bigger and bigger and bigger, which is definitely going to help create a compounding machine when it comes to building out a portfolio that an investor might want to use for retirement. So next, it's time to go over the exact numbers. You saw the title of the video. I said that just $50,000 invested into something like SCHD could, in theory, possibly be enough to retire off. Now, in this dividend calculator, we have the breakdown as follow: a $50,000 initial starting principal investment into something like SCHD. And again, this can work with other names also, but for me personally, I'm writing SCHD all the way to retirement. Now, SCHD currently has around a 3.7% initial annual dividend yield, a 9% amount annual increase, which could be higher or lower. I'm just going off of something in the middle. Now, with that, we have a 3% annual share price appreciation. We have a $1,200 annual contribution on top of the initial $50,000, because in this example, we're saying we're going to add an extra $100 on top of this just to speed up the process a little bit. So now if we add that all up, the numbers are in, we can see very simply that year number one, a $50,000 investment would return around $1,800 or so in dividends per year. Now, if in fact those dividends were reinvested back into more shares of SCHD, which is going to be crucial in building a massive snowball of wealth, especially if you're trying to speed up the process. By year number two, this investor would have around $54,000 invested in SCHD and around $2,200 per year in dividends. By year number three, around $58,000 and $2,500 per year in dividends. So for an investor, again, if you're younger, that's going to be better, because the longer you're in the market and the longer you keep reinvesting, the better and steeper the compounding curve will happen. So by 10 years in, let's say an investor is say 25 or 30 years old. So by 10 years in, they'd be 35 or 40 years old. They would already have a portfolio of around $106,000 and almost $6,800 per year in dividends. By year number 15, an investor would have around $172,000 and almost $15,000 per year in dividends. Now, even 15 years in, obviously, it's great to have $172,000 and almost $15,000 per year in dividends, but that's still not enough to retire off of, not even close. But as you see, from year 15 to 30, the numbers get bigger and they get bigger faster. By year number 20, are almost $300,000 invested and around $33,000 per year in dividends. So now we're starting to get somewhere. By year number 22, $383,000 and around $48,000 or $49,000 per year in dividends. And by year number 25, $580,000 and $87,000 per year in dividends. And all the way at the bottom, year number 30, of course, these numbers can change. If an investor, say, adds more annual contribution, or let's say SCHD, raises their dividend faster, etc., etc., an investor could have around $1.3 million and around $269,000 per year in dividends. So once again, before anyone says anything, these numbers are all just estimated. It's just going off of the numbers that we plugged in, of course. But in theory, there is proof that an investor that starts with just $50,000 invested into something like SCHD or a different stock or ETF that has similar metrics, in theory, as long as they keep reinvesting the dividends, and as long as they have a decent amount of time frame to hold on to this portfolio and let it keep growing and doing its thing, an investor could be left with a massive amount of net worth when it comes to retirement, or even before then, and a crazy amount of dividend income on a yearly basis. But now I want to hear from you guys down below. If you are currently building a long-term portfolio that you're looking to use during retirement, what is the number one largest position that you're trying to build out right now? Comment the stock or ETF in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.